Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Kimberly Flynn. She is the president of XA Investments. She is a partner in the firm and responsible for all product and business development activities. Kim is responsible for the firm's proprietary fund platform and consulting practice. She is also has earned her CFA designation and is a member of the CFA Institute and CFA Society Chicago, and also has her Series 7, 63, and 24 license. Kimberly, I am looking forward to today's conversation. Welcome to The Wealth Flow.
Thank you, Keith. Great to be here.
Yeah, I love to start, though, with every guest and kind of where you grew up. Tell me a little bit about yourself and what got you into this world of investments.
Well, I'm from Oklahoma, and my 30th high school reunion is coming up in a couple of weeks. So my family is all still in Oklahoma, and I guess my mother recalls that I told her in ninth grade that I was going to graduate and leave and never come back. And I've lived in Chicago now for about 25 years, but so a very, very
Oh, wow.
Midwest upbringing. I love Oklahoma, but in terms of the career aspirations that I had in terms of finance and asset management, there wasn't going to be much opportunity. I've always said that if you're a lawyer, a doctor, or an oilman in Oklahoma, you can live like a king.
Yeah.
And they're great people, and it's kind of wide open spaces in much of Oklahoma. And so it's great because I get to go back and be with family. But I do love living in Chicago. I've lived in Chicago now twice as long as I ever lived in Oklahoma. And we live right downtown in the city. So I know a lot of people who are from Chicago are kind of scattered across the suburbs. But growing up, in a town in Oklahoma, I really wanted to live in the city. So I've been able to do that here.
Yeah, perfect. And what led you to get into the investment world?
I used to babysit for a girl down the street, and her father was a commercial banker, and I was sort of early exploring different career pathways, and he told me, he said, well, you should be an investment banker, and that was probably when I was, I don't know, 12 or 13. So I did do that. I graduated from Notre Dame with a finance degree, and I worked at Morgan Stanley for about 3 years out of school in the investment banking division. And I suppose I never worked in commercial banking, but I enjoyed it. And but I figured out that a career in investment banking was ultimately going to be a career in sales. So I decided that I enjoyed being an analyst, but being a managing director at an investment bank was really about selling companies, and you ended up traveling quite a bit as a senior investment banker. So I opted out pretty early. And so after business school, I decided to go into asset management, just thinking that, as a planner, I knew I wanted a family, and I have 2 kids, 2 teenagers right now. And I've always worked, and so for that to be sustainable, I thought asset management would be a really great industry, and I've found that to be true. I've mentored a lot of women, and I think it really is an area where you can have a fantastic career. A lot of the work that I do is capital markets driven, so every day is different, and that's exciting. Um, and but you also have market hours that kind of start and cap the day. So with investment banking, it was pretty much a 24-hour on call type situation. So, I've always enjoyed the long career I've had in asset management. But I do think as a launching pad, investment banking was a good place to start, and I always recommend it for young, ambitious people. There's probably no better learning curve. Go spend 2 or 3 years learning and getting paid to learn. You work 100 hours a week or more, but it's a lot of fun because you're working with other really smart people. So, and what better time to go put those hours in when you don't have kids, you don't have a dog, you don't
Right.
have some of the responsibilities that later in life, start to take up a lot of the time.
For sure, for sure. Well, tell us a little bit about XA Investments and what your. I know we were talking a little bit ahead of the show, but for the audience, tell us a little bit about what makes XA Investments unique, and kind of what all you do.
Well, so I don't think I ever set out to do something entrepreneurial, working in asset management or working in finance. I would say that it's sort of frowned upon because you're talking about, I worked at Morgan Stanley and then I worked at Nuveen Investments. These are large, well regarded, well established firms. But at a certain point, like, I think in technology or in other industries, being entrepreneurial or starting up a new business is encouraged or sort of cheered. And when we started this business 9 years ago, we started it from zero. Nothing existed, but we never really talked about it as if it was a startup, because you don't really, in finance, if you want to manage people's money, they don't want to hear that, that
You're
it's a
just starting.
startup. So it's a funny thing in finance. There's plenty of fintech firms that get a lot of praise, but we weren't starting a fintech business. We were starting a classic asset manager. And in a world where, you have trillion-dollar managers like Blackstone or, BlackRock, it can be daunting. But like anything else, we had an idea around making alternative investments more accessible. And my whole career has been spent, the time at Nuveen and the time here, focused on SEC registered um, products, and that umbrella includes mutual funds, ETFs, and something that's very niche that most people don't know about, which is closed-end funds. Sometimes people are familiar with listed closed-end funds. Um, Nuveen was a leader in that market because of their municipal bond heritage. And a lot of listed closed-end funds are income, oriented, income focused, not necessarily alternative focused. And so I wanted to take what I knew at Nuveen about these structures and use them to open up the private markets. And we were early. The firm was founded in 2016. We now have about $1 billion of assets under management in 3 funds. But I'd say the thing that people usually want to chat with us about now that the there's so many large asset managers, both traditional mutual fund firms and large alternative managers like Apollo and KKR and many others, trying to go after the individual investor. This is making headlines, every single day. And it's people talk about the democratization of alternative investments. They talk about the growth of evergreen products into private wealth. And there's this big movement, like I said, to capture retail investment dollars. And so, but you have to have the right access point, right? So, people could buy private equity, and if they could, get access to a private fund, if they didn't mind getting a K-1 tax form, but that's usually only the wealthiest US investors are going to be doing much private fund investing. The average investor is not likely to do it because of the hassle, maybe because they don't meet the investment minimums. And so having something that is SEC registered means it's accessible. You can have a 1099 tax form. You have the protections that are offered by mutual funds, things like an independent fund board that's looking out for shareholders. So the advent of these types of product innovations, I'm a product nerd, so I get excited about that. But what it means for, average people is that retirement now you might have more choice in your retirement account than just being able to access stocks or bonds. So we're opening up the field of possible investments to exciting things like infrastructure, farmland, um, private equity. Um, Private equity, I think, is something that a lot of people, especially we hear a lot about companies in the US staying private longer and becoming these big unicorns as private companies. So a lot of that growth trajectory is happening when they're private. So as an investor, you need to get in and invest with some of these exciting companies, like SpaceX is a good example, Palantir, which did recently go public. But if you're missing out on a lot of the growth because these companies are remaining private, you need an investment option that allows you to invest before the company goes public. So I think, uh, you know, that's an interesting opportunity that most investors clearly understand. I think because most U.S. investors are heavily allocated to the largest US companies, much of which is technology focused. And so I think there's some excitement about being able to access some of these high, fast growing technology companies in the private phase, several years before they're available in the stock market.
Can you maybe explain for the audience, and I don't know if this is happening through, and for myself as well, is this happening? Are you able to do this because of this closed-end funds that you learned about through Nuvir, or and maybe can you just talk a little bit about what that means? Like, what's the difference between a closed-end fund and kind of your traditional mutual fund type of thing?
Yeah, let's start with a mutual fund or an ETF because I think a lot of investors understand a mutual fund. Um, you can get in and out on a daily basis, and a mutual fund typically holds liquid public securities. So you might have, a large cap growth equity fund. You might have an investment grade bond mutual fund, but just largely it's publicly traded securities with some amount of liquidity, so that way investors can come and go on a daily basis. Um, and there are limits. The SEC limits how much um, illiquid investments can be in a mutual fund. So you couldn't put private equity, for example, in a mutual fund because it wouldn't be able to meet those legal limits or legal requirements. And so the big difference, an exchange traded fund, it shares some qualities with a mutual fund, but it is, listed on one of the major exchanges like the New York Stock Exchange. And with an ETF, there's intraday liquidity. Just like a stock, you can buy or sell that ETF at any point during the trading day. And I think they're prized for, tax efficiency and for transparency and liquidity. So when you're talking about SEC registered closed-end funds have been around since 1940, since the 40 Act was established. It's just that it's the advent of using these structures for private market capabilities is newer. It's really only been in the last 20 years And the growth in the market has really taken place over the last 5 years. So there's always been a handful of funds structured in this way. Actually, the when hedge funds were quite popular 15, 20 years ago, these structures were used for different hedge fund strategies. They were also used, so they were kind of used sparingly, I would say. Now, um, these closed-end funds, which are permitted by the SEC to hold less liquid assets. So there's basically no limitation. You could put something that's completely illiquid. Um, and like let's talk about infrastructure because really long investment horizon. If you're going to buy an airport or you're going to buy a toll road, you've got an airplane above your head right now, Keith. So that made me think of it. But the investment horizon for an airport you're talking about 20, 25 years. Like you're not going to
Right.
flip an airport. But the interesting thing with infrastructure, especially because we've all been facing high rates of inflation, um, and so real assets like infrastructure often have inflation hedges built in. There's been a lot of institutional investment in the last 2, 3 years. And now with a lot of the digital assets, a lot of the crypto mining and AI take a lot of power. So a lot of infrastructure firms are investing heavily in infrastructure to support the growth of those sectors. And so infrastructure is something that has been successfully um, put put together. You can buy a fund, infrastructure fund, that's a closed-end fund, just the same way you would buy a mutual fund, and it gives you diversification across a number of different infrastructure properties. But the portfolio manager, because you so many interval funds, these are types of closed-end funds, investors can purchase shares on a daily basis, but the big difference between a mutual fund here is that with a closed end fund, there's a limitation on how you can get out and when you can get out. So you have to have a longer investment horizon in mind because of the fund restrictions. And those are in place because if you're buying infrastructure assets, you don't want the portfolio manager to be a forced seller of these long duration assets. And so investing in alternative investments, especially things like infrastructure or private equity, has long been the domain of endowments or pension funds because they have very long investment horizons. And so, but if an individual is saving for retirement and that's 20 years out or 25 years out, we too have a similar long investment horizon, but yet most of us are investing 100% in daily liquid things. So the notion is you're giving up some return potential because the portfolio is so liquid. And to the extent that you have a longer investment goal in mind, like retirement, you could take a portion of the portfolio, maybe 10%, and put it into private equity, put it into infrastructure, because it's going to deliver on a different risk return spectrum. It's going to behave differently in your portfolio than crypto. It's going to behave differently than technology stocks. And that can be a good thing. And so I think, but there's a trade-off there in terms of the liquidity. If you want to trade out or you want to get out of the investment, you have to wait for a quarterly redemption. And to the extent that other investors want out at the same moment, you might have that redemption request prorated. So that's why there's sort of a managed exit process for these types of funds so that it's an orderly liquidity and the portfolio manager can plan ahead for that. And for some people, that works fine. For others, it may not. They may say, no, absolutely not. I need to know on any given Tuesday that I can get my money. So that speaks to, investment preferences and risk tolerance. But I think what's exciting for all investors is that there's just a lot more choice. And much of these strategies were institutional only. And I think it's great that retirees now have access to things that they didn't just 5 years ago.
Yeah, for sure. Let's on that. So, if it's an infrastructure fund, for instance, and you mentioned being able to get out on a quarterly basis. How
That's
does
right.
that work on the back end, right? If you're funding, I'm thinking. So we do some. We're actually putting together some stuff like this with some data center projects and stuff that we're doing, where there's an opportunity to invest in, say, a gas turbine, which is going to be a longer project, right? But it's requiring, the grid cannot keep up with the demand, as you mentioned on the AI stuff specifically, right? So if you are utilizing a fund as a tool to be able to raise the capital for this investment, it sounds like there's an opportunity to do that through one of these closed-end funds. What is the process on the back end? If you can speak to that, like, if somebody says, "Okay, I'm going to make this investment, but I want to be able to get out," are you basically trading their shares for somebody new coming in, or how is that working to assure that you still have the capital in the project?
You know, yes. So when you are exiting, most of these funds are quarterly and they offer 5% of its outstanding net asset value in so that if people want liquidity, um, there'll be this basket that they can redeem. And they're redeeming those shares directly from the fund, not
Okay,
from other shareholders, if you will. And so it's a planned liquidity provision that every quarter the portfolio manager, and I think, through investment sales orderly and through some income that might be generated, oftentimes portfolio managers also have like a liquidity facility, like a credit facility that they can tap into. And so that
got
way
it.
it's like the same cadence every quarter and they can plan for it and prepare for it. Now, what might happen in, let's say, a 2020, if 10% of the fund puts in requests for liquidity, then people are only going to be prorated, and they'll get half of the demand that they put in for. So because there's 5% a quarter, and so I think it allows for normal in and out. It But to the extent that something goes out of favor or people become concerned, and we've seen this, I think real estate is a good example over the last 3 years, not just real estate focused interval funds, but REITs, non traded REITs. I think people, when you start to question the valuation of the real estate investments in the portfolio, and if they haven't brought valuations down yet, um, new people won't want to go into the fund, and people who, if the valuations are actually being, relatively high, then people are going to want to sell, right, to realize that value. So that's why I think anytime you're talking about a less liquid or illiquid investment, you have to have robust valuation policies and procedures. Sometimes you have to use third party valuation, because if you're, at any point somebody's coming in or coming out of the fund, you want it to be a fair valuation or a true valuation. And so that's why valuation is really an area that the industry has been focused on, because if people don't have confidence in real estate values that are being struck in the portfolio, you're going to have a bunch of sellers and you're going to have no buyers, and then you'll have an imbalance. And so yeah, things do go out of favor, and then you'd have probably multiple periods of people demanding liquidity, and the portfolio manager would have to be ready to address that. Now, that's why I think one of the challenges with um, less liquid funds is making sure that people have the right expectation in terms of like, I think sometimes these products are sold as being, they're sold as being, the focus is on the liquidity, but the actual focus should be on, the practical reality that some of the investors may not get their money exactly when they want it. That will happen. And I think some family offices that we talk with, I think their preference remains for, like you were talking about, a set project. I know in year 7, that's when the exit occurs. So I think that different people are going to have different preferences. Um, uh, Similar to a project based deal, you might have a private fund that has a set term too. So I think I think these evergreen structures, they just go on and they reinvest capital, and so that way different investors can exit, when they choose to exit. Um, but you may be limited in how much you can exit on any given quarterly redemption.
Okay, okay, that makes sense. So most of the ones that you're doing, particularly, I'll stick with the infrastructure example. Those are close-end funds, but they're considered to be evergreen funds, and in the sense that the money essentially is staying there in some form or fashion. There may be investors that come and go, but ultimately, this fund is one that is continues to be open. There's no horizon or set time frame that it ends.
That's right. That's why, like, the evergreen is interesting because even most of the private funds had been, set, drawdown funds that were term provisions, and they'd close. And now even a lot of the alternative investment managers are moving their institutional business to evergreen because then they never have to return the capital. I mean, there's clearly, from an asset manager's perspective, there can be some selfish motivations as to why these product structures change. Um, but having something that's always available for sale and can grow with demand and can shrink if people need liquidity, um, it that's the evergreen nature of these. That's quite typical. It's funny because you could create a term fund if you wanted, but right now, pretty much, I think there's one or two that have set termination provisions, but most of them are evergreen in nature.
Okay. Very interesting. And your company also, just again in talking ahead of the show, does quite a bit on the research side. You want to maybe talk a little bit about that aspect of things? I mean, this is super interesting to me as well. Just had no idea that there were funds out there like that. And I've got another question on that, but let's maybe talk a little bit about the research first.
Well, so we publish the research, like, on, if you follow me on LinkedIn or follow XA Investments, we post daily observations. We have the most robust database. There's now almost 300 funds. We've tried to help industry firms like Bloomberg and Morningstar, which are trying to play catch up. We started our database 9 years ago, and so we've got the most complete set of funds. And if you want to speak to the whole marketplace in terms of where the growth is happening, the market right now is favoring private credit, largely because of the very attractive high yields and so most of the flows are going into private credit. After private credit, private equity, because I would say equity is a little slower to get started, like a new fund, um, because with private credit, you have a yield that you can quote, and those funds are often sold on yield. Private equity is a total return type product, right? You're not getting any current income with private equity, but surprisingly, it's the second largest category, and it's growing pretty quickly. There's a lot of very prestigious firms that have built funds in the space. Managers like Hamilton Lane, for example. Um, Capital Group actually just partnered with KKR for a private equity fund. So we're seeing a lot of participation by large alternative boutiques, um, leading alternative managers, Blackstone, KKR, Apollo, um, Brookfield. They all have interval or tender offer funds. These are sister fund structures. They're just forms of SEC registered funds, and because when I talk about an interval fund, this may be the first time you're hearing about that. That's why the research that we do for financial advisors, most interval funds today are bought by financial advisors. There's not a ton of opportunities for direct to consumer just yet, like Schwab and Fidelity, for example, are not selling interval funds directly to investors on their platform. You do typically have to have a wealth manager to purchase one of these funds. But they're sold across every different channel from most of the independent financial advisors are first movers. Um, there's also independent broker dealers like LPL, Cetera, Commonwealth. They're really active. The wirehouse firms, the Morgan Stanleys and Merrills. Um, Everybody wants to make alternative investors investments available, with some of these shareholder conveniences like a 1099. So that's why there's been such growth and interest. So we track all the trends in the marketplace, who's winning. It's actually a fairly democratic marketplace in terms of the firms that are leading the way. There's not like one. Well, I take that back. I was about to say there's not one clear winner. They're one of the firms which you may not have heard of, but the market leader in this market is a firm called Cliffwater, which was an institutional consultant, and they now have 3 funds, but they are the clear market leader. But there are in the top 20. There are a lot of independent firms, so you don't have to be Blackstone to compete in a market like this. And so I think it's good because it gives financial advisors more choice, and and these types of structures, you name the strategy. You could put a hedge fund strategy, you could put a commodity fund strategy. I think the only thing that's sort of in the realm of alternative that right now doesn't actually fit into one of these product structures is cryptocurrencies, just because the SEC has not allowed direct investment into crypto. But with this SEC administration, I think we'll actually see movement to allow that, because I think there are a lot of financial advisors that want to be able to offer investors. They're getting a ton of calls about it. You can set up a wallet, but if the rest of your money is, managed at Merrill Lynch and you have a relationship with a wealth manager, you want advice from somebody that's managing the rest of your money. So I think there's a lot of innovation remaining in some of these other areas, and so it's exciting that right now we have an SEC that's moving pretty quickly. While the size of the SEC is much smaller, which with a lot of the budget cuts earlier this year, at least they're willing to consider things like alternative investments in 401ks,
For sure.
crypto or 401ks. So it may take a little bit. We have to be patient because, but at least I think it gives the industry the sort of confidence to pursue some of these new initiatives.
Yeah, for sure. And it just gives access. I mean, most people, go through, I mean, a good portion of people go through their lives, right, with investing in their 401k, choosing the stock options or the mutual funds that are available through their employer, and, may only know of that as an option, right? And don't do a whole lot outside of that. And so just having access to some of these other opportunities, I think is important. Now, one question I have is, so if you're purchasing, say, private equity through one of these funds, do you have to be a sophisticated investor, or classified as the term, but basically a sophisticated investor where you've got to certify that you make X amount of money, you have X amount in investment, or is that something that everybody has access to?
Well, that's actually what's great. Part of the reason that the private credit segment, most all of the private credit funds have no suitability restrictions whatsoever.
Okay.
Um, And if for a private fund investment, typically you have to be accredited or you might have to be a
Credited, yeah.
qualified client. So, in addition to making these funds accessible, um, having either no or reduced suitability restrictions does level the playing field. To your point, so I right now it's actually we study what funds are attracting capital, and it's the funds without suitability restrictions. And part of the reason for that is if you're a financial advisor, and you're evaluating an infrastructure product, for example, and you have wealthy clients, you have, moderate, in terms of their wealth, and then you have clients who are smaller, but you want to be able to put everybody in. You might size the allocation differently between your wealthiest clients and the lower end of your client book, but that's what you can sort of solve for the lowest common denominator and then allocate appropriately. And so having no suitability restrictions is really one of the secrets to some of these funds being successful. In the market, though, there are a handful of funds that charge performance fees. So, like a typical they don't actually charge 2 and 20. Some of them are charging like 1.5 and 15, but it is a total return based performance fee. So the SEC allows that, but if you do that, if you charge that kind of performance fee, then you can only sell that product to qualified clients, which is like a
Okay.
5 million. So it's not quite as high as like a qualified purchaser. And so depending on your wealth, that may or may not be appropriate for you, or your advisor um, but it is still a small part of the market. Um, those funds that have those kind of suitability restrictions imposed, and I think that's because the SEC, I think, wants to make sure that, you know, e- retail investors don't go into products with performance fees and then not realize that that's what, they're getting charged that. I don't really have a problem with performance fees because it does create alignment. One of the trends that we've noticed is that there are managers that are up in quality, and that's a good thing. Some of these institutional managers that want to make their strategies available, but if they charge institutions performance fees, they want to charge the private wealth channel performance fees. They want to keep it consistent, and I'm
Yes.
fine with that. Um, and because like there's only so much capacity these managers have. Think about the best private equity managers. Like as an individual investor, you don't want a watered down, or you don't want the B team managing your private equity. So
Right.
that's why I
Right.
say, like, I think performance fees can be an indicator of quality in manager, not always, but that's why, I think in our industry, there's a lot of fee sensitivity. And Morningstar, while they don't have some of the research that we have, they have started because these structures have become so popular. Morningstar is starting to write about interval funds, and I would say that their research is right now. Morningstar is focused on fees, and so Morningstar doesn't like the performance fees because it makes the fees the fees are definitely higher if the fund is performing, and that performance fees will be higher. But I actually think that that could be an indicator of um, the quality of the manager and the potential for higher performance. So that's why I say fee sensitivity is fine, but we should really put it in context for some of these capacity constrained managers, because it's not like, you can run a trillion dollars in public equity. You can't run $1 trillion in private equity or in infrastructure. There's different capacity constraints that these managers are going to hit. And, you know, if they need to reserve some of that capacity to make it available to the private wealth, then I think they should get paid the same. We don't want to pay more than institutional investors, but I think we always have to make sure we're getting a quality manager and a quality strategy.
Yeah, for sure. And I mean, if it's done as a percentage anyway, I mean, it kind of seems like, it doesn't seem like it should matter that much if it's a percentage, right? But and I agree, you don't want. How are some of those funds made up? Like say, for instance, the private equity ones. Is it how many typical individual investments are within a private equity fund? Obviously, you get some kind of diversification, which probably is why you don't have to necessarily be an accredited investor because you're not going all in on one specific one, right? But what's a typical makeup?
Private equity is interesting because not all of the private equity funds in our market, but most of them will invest in a mix of primary funds that they buy in the secondary market, maybe at a discount, and then co-investment opportunities. So they're able to invest directly, maybe in a sidecar with the private equity firm. And so the composition of being able to invest, you get some basically um, at the portfolio level, you're getting a mix of what's in those primary, secondary, and co-invests. And so there is a seasoning process that will take place. And so that's why some of the more established private equity funds in the marketplace, like Partners Group, has a fund. AMG Pantheon has a fund. And so they're going to have hundreds of holdings within that fund, partly because they've got 10 plus years of track record. It's an evergreen fund. They've been able to season it over time. So a lot more investment diversification and variety because they're able to, with time, they're able to take on new capital and then deploy that. So it provides diversification for all shareholders. For a brand new fund, any new fund has sort of a getting going problem. And private equity, you need probably a good 100 million to get diversified exposure. And, what you have at the beginning with the first 100 million is probably going to look quite a bit different when you've gotten to the 500 million or $1 billion point. So I think you're raising a good point. And this is why I was saying private equity can be slower in terms of the capital raise, because sometimes people will be like, well, I'll just wait. I'll wait till the fund's a little bit bigger because of your point, I think, about diversification. Now, with private credit, you don't tend to have, you can deploy a lot of capital into a variety of securities because the size is less chunky, right? You can put 2 million to work here or 5 million to work here. With private equity, the check size is a little larger, so it can be harder to get diversification. And one of the trends we actually see our consulting clients doing is because of this issue, because you want diversification day one, is they'll actually take the time to stand up a private fund that then they convert into the registered fund. So that way they've already got a portfolio started.
Okay, that's interesting. And you said as far as being kind of the number one right now that you're seeing out there is in fact the private credit, right? Or at least is that the fastest growing, or is that just as far as allocated fund? Okay,
Well,
which makes
it's like a hot spot. Everybody is launching private credit, partly because, there's a variety of different credit. You got direct lending, you got asset-backed lending, you got structured credit, you have multi-strat credit. And so, and also it's probably faster, easier to build a credit product maybe than like an infrastructure product.
right. Yeah, makes sense. And at some point there's some kind of security that's backing it at some point. Maybe not for the end user, the buyer on when it comes to these funds, but if you're doing private credit, for instance, with respect to real estate, there's something tangible there at the end.
Yeah, I think with direct lending, you basically, what comprises the portfolio is loans, to middle market type companies. And that's why people like real estate debt maybe instead, or they like asset backed lending instead, because there's actually, a tangible property underlying the credit, right? As opposed to just a loan to a company. And asset-backed lending has actually been the hot spot in 2025, partly because it is a bit more resilient than direct lending. In what we've seen have been somewhat, these markets have been a little bit up and down, a little bit volatile in 2025 with some of the trade war concerns. And so I think the asset-backed lenders, because of the underlying assets that provide that tangible sort of security in the loan, um, that's why you see asset-backed lending performing better in an environment like today, even though direct lending has been quite popular the last 3 years.
Yeah. Okay. Very interesting. It's just a whole nother world out there, and it's neat that XA Investments is giving just a broader number of consumers the option to be able to, take an opportunity. And the fact that you don't have to wait around for a K1 is kind of nice too. So,
It is. I mean, like it can sit alongside the rest of your investments, and I think investors are going to start to see interval funds, especially. Now that we've talked about it, I think your listeners will be. You'll start to see it in different places because there are some new direct to consumer platforms that are coming. We think Fidelity and Schwab are investing in technology to build out. This market right now is growing at about a 30% compounded annual growth rate. So there's just a lot of sort of positive signs that this is going to be a big place for investors in the future. And I think we've seen take the growth in the ETF marketplace in the last 10 years. It's just been like gangbusters. And so we read research by McKinsey and Bain, and they talk about alternatives in the private wealth space being sort of the next phase of growth in the asset management industry. So there's a lot of smart people focused on how do we do this? How do we do it right? And it really is kind of just the second inning right now.
yeah, for sure. Well, this has been fascinating. Is there anything else you'd like the audience to know, or maybe a question I didn't ask about XA investment that you want to make sure that we convey before? I've got obviously several more questions. I want to make sure that everybody knows where to find out more about you. But prior to that, is there anything we missed so far?
Well, we do publish our white papers and our research on our website. So that's at xainvestments.com. And then follow us on LinkedIn because we're always posting education and insights on the interval fund market there as well. And we actually do it for financial advisors. We actually do dedicated research for them to help them understand the growth of this market. So I think contact me on LinkedIn or contact me on the website, and we're always happy to be a resource.
Fantastic. Well, Kimberly, I really appreciate this. This has been a very interesting episode. And I do have a couple more questions I ask every guest. And one would just be any advice you might give somebody who is just starting out in their investment career? Not career, but just starting out with their investments.
Well, I think that I think while this conversation is largely focused on sort of some of the innovation in asset management, I think it's important to have healthy skepticism about any new investment. I there's a lot of uh, dinner conversation among friends about crypto, and I always feel like I have to be the counterweight because I feel like some of these investments are really exciting, a lot of potential enhanced return opportunities, but there's also risks that come with it. So just be mindful, with any exciting return opportunity, there's probably a risk you haven't considered. So you got to be balanced in your view. I just think that Americans there's just this fascination, and the market now moves on the largest stocks, which actually means there's a lot more volatility in your portfolio than you realize. Um, and so that's why I'm a big fan of diversifying across a number of different assets. Don't put all your eggs in the same basket. But it seems that a lot of people right now have, and that's a tech focused equity type basket. So, things come in and out of favor. And that's why I think that the private credit part of the interval fund market's so fascinating because investors are earning, 8, 9, 10, 12, 13% current yields, a lot more attractive than what for many years fixed income just wasn't very exciting, wasn't very interesting. So opening the door to things like infrastructure or farmland, I actually think that real estate, I think, gives people a way to understand alternative investments. Many people own their own home. They've got a mortgage on their home. Maybe you own a rental property, and so some of those ways of understanding investment in finance, I think it helps you understand some of these alternative investments too. So don't be afraid to kind of use your own experience because in the U.S., I think a lot of people end up using that to get comfortable with going beyond just stocks and bonds. So I would encourage people to do more research in that way.
Yeah, for sure. And then how about a book recommendation? Doesn't have to be finance or real estate related. It certainly can be, but anything that you've read that's been impactful or interesting?
Well, I'm a true crime person, so I'm not going to give you a finance recommendation, but um, there's a book called Murderland, and it's a nonfiction book by an author named Caroline Fraser. It was just published this year, and it looks at actually. I was talking with my friend who's been at the EPA now for about 20 years, and we were talking about like the environmental impact, basically of pollutants. And this study is basically looking at serial killers like Ted Bundy, who lived in the Pacific Northwest, and there were a lot of smelting factories, a lot of lead pollution in that area. So it's interesting because sadly, we hear a lot about school shootings and things of that nature. So I always like to understand what it is that sort of cause and effect, what makes people act this way or behave this way. And
Yeah, sounds very interesting. Have not had that recommendation, but I'll have to check it out myself. Well, Kimberly, I appreciate you being a guest on the Wealth Flow today, and I think we'll call it a show. Thank you so much.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.